Warren Buffett compares the tariffs imposed by the United States to an act of war. The global economy is entering a new stage of conflict, silent, yet with a direct impact on your money. In this video, you will understand that this economic war is also ongoing, how it affects your investments, and most importantly, what you can do now to protect your wealth while living in Europe. In a rare recent interview, Warren Buffett classified trade tariffs as an act of war. This expression carries strategic weight. It is not merely about taxes or customs agreements, but about moves that can reconfigure economic alliances and impact billions in global capital. Buffett is not talking about a distant future. He is referring to decisions being made now, primarily by the United States, that could trigger a wave of instability in the markets. Tensions between the United States and China, for example, are no longer news. But now, the European Union is also on the front line. Trade disputes, subsidy policies, and tariff threats circulate among the major capitals of the world. And why does this matter to you living in Europe? Because in a globalized economy, no decision made by the United States occurs in isolation. Stock markets react, interest rates adjust, capital flows migrate from one continent to another, and the impact reaches your investment portfolio. But what makes tariffs so dangerous that Buffett would use the term war? And how exactly does this mechanism affect prices, inflation, and your cost of living? To understand this clearly, we need to take a closer look at how tariffs work and why they have returned to the center of global economic policy. Tariffs are, in essence, taxes applied on imported goods. The logic seems simple. By taxing a good that comes from abroad, the government makes that product more expensive, encouraging the purchase of alternatives produced domestically. However, in practice, the consequences are much more complex. Tariffs change prices, alter investment decisions, and redistribute competitiveness between entire countries. Most importantly, they impact your wallet, even if you have never imported anything directly. Consider a recent example. The United States imposed tariffs on Brazilian steel. At first glance, this may seem like a distant conflict limited to two countries in the Americas, but the effect is global. The increased cost of Brazilian steel, which supplies various industries in the US, forces manufacturers to seek new sources, often more expensive, less efficient, or with logistical bottlenecks. This raises production costs not only in the United States, but also for European companies that are part of the same supply chain. This cost pressure spreads rapidly. The prices of parts, machinery, and industrial equipment rise. And, as a consequence, so do the final products that reach European consumers. Even without a tariff directly applied to Europe, the effects arrive through indirect channels. And it doesn't stop there. The European Union, in response to distortions caused by Chinese subsidies, is also considering imposing tariffs on electric vehicles imported from China. The cycle repeats. Tariffs on one side, retaliations on the other. The global economy enters a defensive mode, with each bloc attempting to protect its industry. But which European countries and sectors are most vulnerable to this new protectionism? And why does this reality demand a profound adjustment in how you invest and protect your assets? In times of structural instability, protecting assets requires more than foresight. It demands preparation. The first step is to reassess the allocation between traditional financial assets and real assets. Bonds and stocks remain relevant, but in proportions that reflect the new scenario. Diversification must move away from being generic and become strategic. Historically resilient sectors are gaining prominence in this context. Infrastructure and essential consumption continue to deliver results even during slowdowns. Companies with stable revenues, low exposure to global trade, and pricing power are better able to maintain dividends and preserve value. This is particularly true for those seeking protection without sacrificing yield. Gold, for its part, resumes its classic role as a store of value. More than a symbolic protection, it represents a real defense against currency and monetary shocks. Multi-asset funds with currency hedging and controlled global exposure are also gaining traction. They combine flexibility with protection against the volatility that is increasing in core markets. Another critical point is to reduce concentration in companies with a high dependence on exports, especially those sensitive to tariffs and long supply chains. The new economic order favors more self-sufficient models with regional production and cost control. This is not about abandoning risky assets, but about reformulating the balance between growth and preservation. And while many continue to bet on normality, the data shows a different reality. The system is changing. Warren Buffett does not issue alerts lightly, and the use of the term economic war signals that the game has changed. Silently, without dramatic headlines, the fundamentals of the global market are being reshaped. Tariffs, inflation, and geopolitical tensions are already affecting investment decisions, monetary policy, and the real value of the money you hold today. If this video brought clarity, please give it a like to help this alert reach more people, and subscribe to receive more content that will help you protect your assets. We will see you in the next video. Europe is among the regions most exposed to the dynamics of international trade. With an economy based on exports and production chains distributed across various countries in the bloc, any alteration in global flows generates immediate reflections. A single adjustment in import rules can affect factories in Italy, suppliers in Slovakia, and engineering centers in Germany. However, the impact does not stop at the industry. As tariffs and protectionist policies gain ground, European companies lose competitiveness in external markets. Sectors such as technology, automotive, and industrial equipment, which once led exports, face increasingly squeezed margins. And when profits shrink, the shares of these companies lose value. This directly affects the portfolios of investment funds, private pension plans, and individual investors who rely on long-term growth. Meanwhile, the euro faces constant pressure. The European Central Bank deals with a reality distinct from American monetary policy. While the United States raises interest rates to contain inflation, Europe hesitates, attempting to balance financial stability with growth stimulus. This divergence puts pressure on the exchange rate, increases volatility, and creates additional risks for those investing in international assets or relying on returns in strong currencies. And the inevitable question arises: if global fundamentals are changing, is your portfolio prepared? Warren Buffett has been warning about the trade deficit of the United States for decades. For him, the issue is not only in the numbers, but in what they represent: a constant transfer of wealth and autonomy. When a country buys more than it sells, as the United States has been doing systematically, it pays this difference with currency, in this case, dollars. But these dollars do not disappear. They return to the global system, buying assets elsewhere. And this is where the implications become visible, including in Europe. Buffett used a simple metaphor to illustrate this process. Imagine a fictional country that sells luxury goods to Americans. By the end of the year, this country is full of dollars. As it does not use this currency internally, it needs to give it a destination. Real estate, stocks, companies, or government bonds, all in the United States. But substitute this fictional country with any exporting nation. And now think, where are these flows going today? With the increase in dollar reserves outside the United States, large investors and sovereign funds are beginning to purchase assets around the world, including properties and companies in Europe. This dynamic accelerates during times of uncertainty, such as now. In cities like Berlin, Milan, or Amsterdam, it is already common to see entire buildings under the control of international funds. Europe, silently, is selling parts of its future in exchange for short-term liquidity. But if this new global order concentrates wealth and increases dependence, what becomes of traditional European assets? The effects of the economic war are not theoretical. They are already evident today in the data on inflation and in reports on asset performance across Europe. The combination of tariffs, geopolitical tensions, and high energy costs has pushed prices upwards, creating persistent inflation in the Eurozone. Even after the peaks of 2022, the pace of decline is slow, and the pass-through effects are still felt in everyday consumption and corporate balances. However, inflation in itself is only the first signal. The European Central Bank faces a visible dilemma. On one hand, it needs to curb inflation with higher interest rates. On the other hand, it fears suffocating economies already weakened by industrial decline. This hesitation creates uncertainty in the markets, directly affecting the prices of financial assets. It is precisely in this ambiguity that serious risks emerge for investors. Real estate funds, for example, have suffered from rising interest rates and pressure on the construction sector. Exporting companies, once competitive, now face reduced margins due to external tariffs and global slowdown. Cyclical stocks linked to consumption and industry also show greater volatility and lower returns. The European investor finds themselves surrounded by assets that just yesterday seemed solid but today fluctuate without predictability. Behind this, there is a structural decline in industrial productivity. Lower investment, logistical bottlenecks, and high capital costs make it more difficult to maintain margins and dividends. And when the industrial base loses strength, the entire financial system feels the impact. What should be done in the face of this new cycle of instability? Which assets still offer real protection? And how to structure a portfolio that can withstand a prolonged scenario of pressure and uncertainty?